Welcome to the latest episode of Quest for Twice. In this episode, I'm going to provide updates on the three companies I invest in. The first one is JFrog. So it's interesting to look at the views from GitLab. GitLab also provides DevOps tools. So they are a competitor to JFrog. So according to GitLab, JFrog Artifactory is an industry leader in artifact management and does not have major gaps. So this is a very strong remark about the flagship product by JFrog, that is Artifactory. So I think this confirms my initial thought about the narrow mode JFrog has. However, GitLab has tools that can manage the entire DevOps cycle, including the very beginning of the source codes. As a comparison, JFrog Artifactory manages binaries, so the source codes are managed by other companies' tools. So the key question is that can JFrog leverage its Artifactory strength to compensate for the integration gap it has, given the fact that it does not manage the steps before binaries. So I believe this key question will decide on the growth of JFrog in the coming years. And it's something to keep an eye on. And the best metric to watch for is the adoption of the JFrog pipeline at the Enterprise Plus subscription level. So if JFrog can continue the market adoption of its Enterprise Plus subscription, then that means it can compete into the full DevOps cycle. One last point to note is that GitLab its valuation level is much higher at 75 price to sales ratio compared to 19 for JFrog. So that's almost 4 times higher for GitLab compared to JFrog. I believe the risk award consideration is in the favor of JFrog. I'm going to provide a quick update on Kinder Morgan. So Kinder Morgan reported the Q3 earning in this week. Really, it's kind of a boring update because very little has changed. So its valuation level went up slightly because its stock price went up slightly. Its 2021 EBITDA outlook stays the same. Its debt increased by about $1.5 billion. That's mostly because Kinder Morgan spent almost $1.2 billion to buy Stagecoach Gas in the third quarter. Its 2021 DCF remains the same compared to its outlook from end of Q2. And its capex plan has not really materially changed either. So in summary, Kinder Morgan is on track to deliver strong dividend. As a comparison, there is a lot to talk about the Boston Beer Company, and based on its most recent earning report. So for the year of 2021, And in the first 9 months, the Boston beer sold about 30% more barrels compared to the first 9 months of year 2020. However, its recent outlook gives kind of a gloomy outlook for the Q4 2021. And it's basically about the same or even potentially a negative growth for the remainder of this year compared to 1 year ago. That's because of the rapid deceleration of the hard seltzer for the whole industry, and the Boston Beer Company is also affected. However, what's more important is Boston Beer Company provided the preliminary 2022 outlook. So the barrels sold is forecasted to have somewhere between mid-single digit and low double digits growth in next year compared to 2021. And also importantly, it plans to raise price by about 3 to 6%. And its gross margin will be between 45% and 48%. So looking at the gross margin history for Boston Beers, the 45 to 48% is similar as what it delivered in the last 2-3 years when it's growing the hard seltzer segment very rapidly. So it's fair to say that the Boston Beer Company sees its gross margin has bottomed in 2021 and will recover in the coming years, which matches my investment thesis I did in last month. And also, it's reassuring to hear the management thinks it can grow both volume as well as raise price in next year, and that demonstrates that the management is optimistic about its growth potential in the coming years. So if I use the 12% revenue growth as in the 2022 outlook midpoint, then I can update the revenue for 2022 in my spreadsheet. And we can see that the growth trend for Boston Beer is still continuing. And using the gross margin of 46.5%, then its enterprise value over EBITDA using 2022 EBITDA will be about 14. And that's reasonable for a growth stock. So at the end of the day, it's all about how fast the future growth will be. So historically, Boston Beer Company has been growing its revenue at about 12% CAGR. And I think there is a good reason to believe that it can continue that historical trend, but only time will tell. So to sum it up, let me review my initial investment thesis and risks. So my investment thesis was Boston Beer Company was a high growth company that is reasonably valued because hard seltzer is not going away. Once people getting used to it, they will likely keep drinking it. And also, deceleration is not a decline in sales. So deceleration is disappointing, but if it can keep up with its historical CAGR, then it'll be fine. So I give it a star for the intact investment thesis. In terms of threats and opportunities, in the past, I listed that in near term, the gross margin and the EBITDA margin will improve once its own facilities come online. So that's still intact. And midterm, the brand asset will grow from more marketing and sales spending. And it should drive sales higher. So I think the time will tell, but I still believe in it. So long term, when will hard sales or market share stop growing? And that's really a big question. And we don't know the answer to that. Only time will tell. So in summary, my initial investment thesis and the risks still stand. So at the current valuation level, I would continue to hold and hope the sales projection for 2022 will materialize and the company stock will start to move higher again. So until next time, happy investing.